So to be effective in working and growing a startup versus an SME, you need to be able to identify which is which. And this can be achieved by looking at the following factors: growth patterns, risk profile, scaling potential, investment sources, the innovation style, and the life expectancy of the company. To keep it simple, I've grouped them under growth patterns, risk profile, and investment sources. So first, let's review growth patterns. Investors expect a startup to experience 10x high growth, particularly in the first few years. I'm sure you've heard of 10x. Everything nowadays is marketed as bigger, faster, and better. And as humans, whether we like it or not, we're engineered to always want this, not necessarily to need this. 10x means to maximize and expand your results 10 times over, rather than just by 10%. So in terms of sales growth or revenue, if your company makes $100,000 in revenue in year one, according to 10x, it's expected to make $1 million in year two, then $10 million in year three. Now, of course, you can measure growth in many ways, including, as I said, FTE or full-time equivalent headcount, and many other forms of return on investment. But in terms of using external capital to grow, you will be confronted with 10x expectations. If you take hungry investors' money, they will want a 10x return on their investment. Numbers always look easy in an Excel spreadsheet, but how realistic is that expectation? Well, all new companies should experience at least a 50% increase in revenue year on year for the first few years post capital raise or after receiving their investment. My previous company used this measure to determine company success. After new companies would get venture capital funding, it was expected that they grow using a year-on-year growth rate of 50% minimum. Now, if you have a great product and you know what you're doing, then you should be able to bootstrap or self-fund a micro or small business to achieve these levels. In Australia, the term high growth firm means a company that increases its revenue by just 20% year on year. So not all companies are meant for rapid exponential or compounding growth over time. An SME that is well resourced can expect to experience 50% year on year growth for the first few years, then 20%. However, SMEs should focus on early profitability rather than land grab or market share. Many startups, particularly SaaS-based companies, don't aim to be profitable. They focus on customer acquisition, or what's referred to as land grab. But there's a growing movement, even in Silicon Valley, that this model is due to change. For an SME, early profitability is required for long-term sustainability. And generally, SMEs do not grow quickly or are not expected to. Remember, we're talking about companies that make and build real tangible products, not SaaS companies where customer acquisition is the priority. A startup will go big or die. If successful, a startup aims to become an Atlassian, Facebook, or Google, or exits along the way, or gets sold. So if unsuccessful, it goes to zero, and everyone is unemployed. Now, I've spent a few years evaluating startups chasing exponential growth. And as you know, my heart lies in supporting SMEs. While it's not impossible, attaining unicorn status can be incredibly difficult. In fact, a business only has a 0.00006% chance of becoming a unicorn. And it takes an average of 7 years for nascent startups to grow into unicorns. Nascent is a business without a product yet launched on the market. So simply put, your chances of building a successful, profitable SME that pay you a handsome salary and achieve long-term sustainability is realistic. Obviously, startups are high risk. Most of the time they die. So I've put a link in this article to reveal some figures on failure rates. There's a lot of conflicting data on business failure rates, but it's widely reported that 20% of small businesses fail in their first year, 30% of small businesses fail in their second year, and 50% of small businesses fail after 5 years in business. Finally, 70% of small business owners fail in their 10th year in business. So, failure rates are reasonably low in the first couple of years. This is because founders will borrow from the 3 F's to stay afloat. They'll borrow money from friends, family, and fools. So, if you're chasing exponential growth and reliant on rounds and subsequent rounds of funding, your chances of success are greatly reduced. SMEs are less risky, lower than startups, but still high to medium risk. For example, opening a bakery where there's no foot traffic is obviously a huge risk, but there's ways to minimize risk, and for an SME, they're better understood. So let's then consider, is it worth evaluating business opportunities? And can we increase the odds of success? Well, if you flip a two-sided coin, heads and tails, you have a 50% chance of successfully predicting an outcome. So, if you consider the odds of picking a company that will succeed versus one that will fail, according to profitability, you'd have 50% odds of getting it right. Interesting, huh? So, I've examined sound research on early stage venture capital investment returns that shows VCs often would have been better off flipping a coin. And don't even get me started on Shark Tank or Dragon Den, their style of screening, evaluating and selecting opportunities. Depending on how they wake up feeling that morning, they may or may not think your idea is worth investing. Although I must admit those TV shows are great to watch and you do learn a lot. So take a look at this slide. If you invest into 250 companies of $100,000 each parcel of investment, 162 will lose money and fail. 87 of your investments will find some success, and only 1 will become a new growth engine. So you have to invest $100,000 into 250 separate companies to make it big. The 162 failures are depicted in the red on the bar chart. 6 out of 10 investments lose money. This means the majority of projects invested into fail and don't even return the invested capital. 87 investments into business ventures find some success. In the orange, we can see 3 out of 10 investments show some performance. These are early stage investments which return between 1 and 20x the investment capital. However, when you look closely at the orange bar, you can see that nearly most of the performance is small, only returning between 1 to 5x the invested capital. And finally, in the green, we can see that only 4 out of 1,000 investments show large performance. Only 1 out of 250 innovation projects will return 50 times or more the capital back to the investor. So now you can see why investors will demand and often only look at business opportunities that offer at least 10x returns. This slide's always here for your reference, and you can explain it to others who are considering investing. So now you probably want to ask me, if you can't predict winners, what's the point? Well, you can increase the odds of success. A Newledge CDI is built around what makes an SME succeed with innovation. Once we know we have an opportunity, we then allow you to assess whether a company can absorb and implement innovation. But more on that later in the program. We're still in Module 2, where we prepare you for the guts of the Newledge program. Like we said, with startups, it's about going big or going home. And the way to this kind of growth is to scale into larger, more profitable markets. If they do manage to crack those markets, they can grow at the 10x rate their investors desire. But it's still a pretty big if. SMEs, on the other hand, they're not driven purely by numbers. They can innovate once they have achieved success in known markets. Then they can actually use disruptive innovation techniques to grab a foothold in low-end markets and scale up into more profitable main markets. You're going to learn how companies like insulation tech located down in Tasmania, did this successfully. Usually, though, SMEs will experience scale through franchising, additional locations, or vertical integration. So vertical integration is where a company owns and controls its suppliers, distributors, retail locations. It wants to control its value or supply chain. Okay, so regarding investment sources, there are two distinct types of investment sources available for startups and SMEs. They're very different. Startups get their funds from other entrepreneurs or high growth investors, such as angels, and not the type with wings that live in the sky. Angel investors are small groups of wealthy private individuals or small groups. Venture capital, which is employees of venture capital firms that invest other people's money, which they hold in a fund, into companies. Equity crowdfunding, and this is the area of investment I've been working in for the last 5 years, where companies exchange equity or shares for growth and expansion capital. And debt financing. Debt financing is the kind of the opposite of equity funding. Debt financing involves the borrowing of money and paying it back with interest, but you keep your company's equity or shares. SMEs are likely to fund their development through entrepreneurs, family, friends, fools, secured investors, loans, and grants. So the former investment sources tied to startups expect big returns and fast. But with SMEs, there's less pressure to deliver on unrealistic expectations. So my previous company, previous to Newledge, was bootstrapped. I put in a small amount of money and worked labour or sweat in exchange for equity or more shareholding. After licensing our software, I was able to then bootstrap or self-fund Newledge myself. So I worked my way up to 100% ownership of a new SME. I did use grants, and I'll show you how I did that. Personally, what I love most about this method is control. As soon as you take in outside investment, you will lose some control. This is one of the main reasons I highly recommend my students sharpen their skills first as intrapreneurs, then become entrepreneurs.